Welcome to you. We're at in Yvonne's kitchen again. This is Yvonne Jenkins of pinkinvestments.org, and today we're going to be talking about any investment, actually, whether you're building up wealth or whether you have a lump sum to invest. And Yvonne is going to take us through everything that we could possibly do with our money, especially, what's risky, what's not risky. I know you've got a better way of saying it, so I'm just going to hand straight over to Yvonne.
Well, really, I think as we were saying in the last video, this crossover between savings and investing has always been a bit of a threshold, and particularly for women. And really, once we can break down a lot of this terminology, understand some of the main asset classes, so i.e. the different mixtures of types of investment, then really you can start to see it really isn't rocket science. The other thing, at the same time, I've devised what I call my investment risk pyramid. And I did this literally so that, as you can see on here, we actually start down on the bottom rung, if you like, and that's cash. And that, of course, is...
Can I just say before we go on, because I love this, and I know that you can't read it properly, but you will find it in detail. I know you're going to talk about it now, so that's fine. But when you want to have a look at it, just have a look on our ebook, our Beginners
ebook. It also appears in the main ebook because it is a really important section for really grasping those sort of fundamentals of investing. And I think it graphically just depicts in one fell swoop really the different asset classes, mixtures of investments, but also the different risk levels of those, so that you then can use that to evaluate for your own self, well, what level of risk am I prepared to live with, and then i.e. well, which type of investments then will I feel comfortable with, in my investment portfolio. And that's whether you're building up wealth by starting to accumulate it, or whether you've got a lump sum together already. The same principles apply. So what we'll do now is literally we'll just go through step by step, as I say. So we'll start right at this bottom rung here, which is cash. A lot of you, of course, are familiar with cash, and in the main, that's how we actually build up our wealth to start with, is by saving, putting it into higher interest accounts.
So it's not just in your piggy bank. We're talking.
You will generally find that you will get a higher interest rate if you can put it into a term deposit, which is a set period of time. It might be a 6-month term deposit, a 1-year term deposit. So, if you've got more than a couple of £100, if you've got £1,000, 5,000 or something, on a lump sum like that, from your savings, you will get a better rate of return from the banks and building societies if you're prepared to lock it away for a period. It doesn't have to be a long period of time, but 6 months, a year, whatever. So cash.
So basically, you would, at the end of that time, get the money back and the interest.
Do something else, with the interest, of course, and then do something else with it, either reinvest it for another set term, or look at some other asset class to maybe get a better rate of return.
So it's right at the bottom of the pyramid because there is no
risk. As you may know, during the global, and having said that, you have to qualify that a bit. For years and years, you could say cash on deposit in the UK had no risk attached to it at all. Of course, then the global financial crisis came along, and we nearly had a couple of the banks and building societies go under. So the government then came in and actually put this guaranteed amount, 85,000 it is currently. So literally with any one institution, bank or building society, if you've got 85 or up to £85,000 invested, literally the government guarantees that you cannot possibly lose that money. So it's like a big safety net.
However, I remember Yvonne and I were talking about this a little while ago, and you pointed out that actually one organisation isn't just that single bank, it's the whole umbrella, isn't it?
That's a very good point, Ruth, actually.
HSBC, don't they own everything?
Santander now, who own actually HSBC as well.
Oh, okay.
But no, sorry, that's wrong. They don't own them. But Santander is a good point in question because they own what used to be the old Abbey National. They've got ties, with all sorts of the other old banking institutions that we used to know in the UK. So, yeah, that's a good point because if you think, okay, well, I've got a Santander account, I've got 85,000 in there, I've got an old Abbey National account, there's 50,000 in there. Well, actually, it's the government only guarantees it for the one institution. So any other groups within that institution, you might want to spread that out to other completely different ones, so that you do get that. That's quite a nice position to be in, actually, if you've got a number of 85,000s hanging around. A lot of us won't be in that position. We'll be looking at smaller amounts of money. But basically,
but
cash.
That's the reassurance that we've got, isn't it?
That's why it's on the lowest rung of the ladder.
Within whatever things in that whole group and within that one institution, it's safe. What's next on the pyramid?
From a risk point of view, no risk really to cash. Okay, you can sleep at night. You're not going to lose your capital. Okay. Next up on the risk pyramid here is what we call fixed interest securities. A lot of people say, "What on earth is that?" Well, really, they can be government-backed bonds. They usually call them. In the UK, they are called gilts. In the USA, you will hear them referred to as treasury bonds. And simply what they are, they're like a type of big, huge, massive IOU, if you like. So the government gets money in from investors and, again, guarantees them a certain rate of return if the money is invested for a certain period of time. There's a lot in the ebook about government bonds, fixed interest. We're not going to go into it today. There is a number of, a lot of jargonified sort of terminology surrounding it. But basically, it's an area where a lot of people ignore it. But it can be quite handy, particularly for people wanting income from their investment, and again having at least the security of having a government backing behind some sort of investment.
Is that where premium bonds come in?
It's a similar-ish type of thing.
Is it on that kind
premium
of
bonds, Ernie, in the UK. It is actually run by the government, and in fact the government are borrowing funds really from the public. I think to the tune now with Ernie, something in the region of £40 billion is actually invested in premium bonds. It's a slightly different thing because you don't get the coupon that you would get, which is basically the interest rate that you get on a
just
government
the excitement
bond.
and the hope that we all live with. Okay.
Yeah. So there you go. That's the second run on the ladder. Is a little bit more risk involved than having cash, and why that is that if you don't hold these government bonds for the set term, and you have to, for whatever reason, sell them out before that, you will only get back what the market actually determines from that. So you might make a profit, you might make a slight loss. So there is some small element of risk if you don't hold them to maturity. Anyway, moving on swiftly up the ladder now is the next area, which we will call managed funds, or in fact in the UK it's mostly unit trusts. And here, again, you will have seen a lot of literature, particularly around the ISA time, in the run up to the end of the tax year in the UK, March, April, you get loads and loads of unit trust groups, coming out with their latest ISA and different funds that you can invest into.
What does ISA stand for?
It's just an individual savings account. It's a tax sheltered savings account. We won't get into those now, but basically unit trusts are like a big pooled investment. So you might have hundreds, thousands, tens of thousands of individual investors like you and I. And we can go in with relatively small amounts of money, £1,000, and invest into a pooled fund or a unit trust. There is a fund manager in the back behind the scenes there, who then manages that money. We might want to go into a unit trust that only invests in British companies. We might want to go into a unit trust that invests into Far Eastern companies, into Chinese companies, whatever it might be. There's a whole range of different unit trusts available. But basically, it is a pooled investment. You buy units in that fund. There's a fund manager then that goes and actually does the diversification or mixture of the underlying assets. and literally you are investing into that with the potential to actually get a greater return on your money than you would on fixed interest and on cash. I.e., the higher you're going up this risk-reward ladder, if you like, the bigger the potential is for the return, but the more risk you're taking on board as well.
Okay.
Each step you go up it.
That sort of sounds like you're putting money in to pay for somebody else to invest the money into whatever they think.
Yes, yeah.
Hopefully it's going to work. That's, yeah, I get that. That's
Yeah.
where the risk is coming in.
And you have some sort of star funder managers from time to time. Fidelity, and certainly I'm not promoting any one unit trust over and above, but certainly from my own experience, at one time in the past there was the Fidelity Special Situations Trust, which was a terrifically high-performing unit trust, which year after year, some years are bringing 20% return and things. And there was a star sort of fund manager that was attached to that particular trust for a period of time.
Let's hope that was a woman.
In that instance, it wasn't, but there's plenty of good ones who are women.
Okay.
Yeah,
Okay. What's next on the ladder?
So moving up now, this is one that often takes people by surprise, and it's property investing. And a lot of women are very sort of happy to go into property as an investment, bricks and mortar. They see it as a very stable and a very sound investment. And it's funny, really, because when you see it on the pyramid like this, there's a whole area in between which they're not so comfortable with, the fixed interest and the unit trusts. And in the past, they might well have perceived those as a higher risk than property. But in fact, property, for a number of reasons, and again, we can't go into it here, but there's a very, very comprehensive bit on property in the main ebook and on the investment ebook, and in the mortgage ebook, in fact. But, at certain times, property is not a good investment, and there is volatility involved even with the property market. So that is the next one up in the risk-reward.
You'll remember that volatility just goes up and down.
Up and down.
That's what it's about.
That's right.
Okay. What's next?
Okay, now we're getting into the sort of upper echelon of the risk and reward pyramid, and we're now coming into shares. Sometimes they're called stocks. In the US, they're called stocks. In the UK, in Europe, they tend to be called shares. And basically, this is where you're literally putting your money into a company. And so you're buying a small chunk of that company, really. And in return for that, in some cases, if you go for big UK companies, you will also get a dividend. But you would also be looking for a capital return on your money. So something, again, bigger than if you were actually just keeping your money on cash and deposit. Shares over a period of sort of 40 years have always historically outperformed cash and fixed interest, so government bonds. However, having said that, they are much more liable to that volatility, as we saw before. That little seesawing sort of effect. You get your ups and downs. But generally, over a period of time, where you might invest in them here, they'll go up, down, but they'll end up sort of over here. So you've got the potential again to get a very much bigger return on your money. But in return for that, you are taking on board more risk. Now, when we get really up into the sort of...
Where have we got to at the top yet?
We're up at the apex.
The very top.
And this is really...
Seriously risky.
It is.
Very exciting. Very exciting.
Well, it is for some people. Other people, they would never even touch this segment of the investing spectrum ever, because they just don't want that amount of volatility in their portfolio. And this is an area which you will have only really started to hear about in the last sort of 10 years or so in the general press and on the TV. It was very rarely talked about years ago, but in the mainstream. It's the derivatives, and that's basically things like futures and options, Forex, foreign exchange trade, and that all really comes in the general terminology of derivatives. And it is an area really which is for sort of quite sophisticated investors that are happy to really take on board quite a high degree of risk, with the prospect of very high returns as well. Generally speaking, it would make up a very small proportion of someone's portfolio, and as I said, for a whole load of people, it would just never even come into their investment portfolio at all. But it's worth knowing about.
Yeah, and for those people who are interested, where are they going to find more information? Are we going to do more videos about that, or have you got?
We will. We've also got an ebook completely devoted to derivatives. Just a mini ebook devoted to derivatives, and we've also got an online learning centre, and there's segments in the online learning centre on, again, all of these different topics that you can go through at your own time, and you know, learn in a different way, again, from what we're doing today.
Okay, thank you so much, Yvonne, because it's just a mystery, isn't it, at first? What do people do with their money? How do they make it? Oh, let's keep it safe in the piggy bank. We know where that is. But so just to clarify, at the bottom there, cash, term deposits,
fixed interest,
government bonds,
yep,
unit trusts. Somebody out there doing it for you.
Yeah.
We sort of like the sound of that, I'm not sure. Property, oh, a bit riskier. Some of us probably know that. And then shares, that whole world about shares, which is so interesting. We're going to look more about that. And then at the top, the very exciting place of derivatives, which I did work out was actually just contracts that derived from an initial contract, something like that. Very exciting. We're going to do more about that. But that's great. Thank you so much, Yvonne, for clarifying all that for us. And remember, we've got that on the ebook on the pinkinvestments.org website. Oh, you're already there, so you'll know that. Okay, see you again soon.